Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, 𝗘𝗀𝗁, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, 𝗘𝗀𝗁𝗘.
Welcome in. This is 𝗘𝗀𝗁𝗘 with Real Estate Radio Live, the podcast version. I'm here with Mike 𝗔𝗕𝗎𝗪𝗔 today. Mike, good to have you here.
Good to be on.
We are back in the saddle again, ladies and gentlemen, and excited for the podcast series for sure. Again, most of you know that no longer doing the live shows, but we got such a great response for the podcast series. We'll continue doing those. And so the lineup will be as follows. Mike will be doing a Monday podcast, and then Mike and I will be excited. We'll be going to do a Tuesday together. Wednesdays and Thursdays, pretty much like the show, live show. And then I'll be doing Wednesdays, Thursdays myself, and then Buddy and Bobby will be alongside on Fridays. So just before we get started, the topic today is going to be kind of an end-of-the-year review in real estate, what's going on with real estate as we wrap up 2016, roll into 2017, and then we're going to talk a little bit about rates, programs, how it's going to affect here the Bay Area and the marketplace. Before we get started, again, if you have any real estate needs at all, be sure to contact Mike. You can do that by contacting him at 408-630-0101 is the contact number, and also the website is 𝗥𝗲𝗋𝗚.com, Mike D as in David, SELLS.com. If you want to reach me for any financing advice, mortgage information, 408-838-9060, easy for me to say, or you could reach me at RERadiolive.com. All right, let's get started. So we're wrapping things up here, Mike, getting close to Christmas time. What do we, tell us a little bit about, I guess first let's start how 2016, kind of shaped up in your opinion, your thoughts. We've been doing this all year. We have just a couple weeks left here in the month of December. Did it give us kind of an idea about Silicon Valley? How did real estate end up? We'll talk about that first a little bit, and then a little bit later we could discuss what you think some of the projections might be for 17.
Yeah, absolutely. I think Silicon Valley is such a unique place. We talk about it a lot on the show. With the year that's gone on, I think it's obviously, in my opinion, has gotten more normal.
Yeah.
And I think that's something that needed to happen personally. This is coming from someone who started selling real estate in 2008, yeah. Which was the worst time to get into real estate. But and selling real estate here in the Silicon Valley the past 4 years or so, it's been pretty hectic. Mm-hmm. And it's still pretty hectic compared to the rest of the country, I would say. But we're getting a little bit more normal here. And what I mean by that is that we saw more inventory come on the market, mm-hmm. which therefore meant there was more for buyers to choose from, which meant there wasn't as many bidding wars or as high of bidding wars as there had been in the years past. So I think that, I guess to summarize everything, the year of 2016, in my opinion, for Silicon Valley was a year of getting towards more normalcy.
Yeah, no, I think that's well said. What do you think contributed to that? I guess what I'm saying is we saw, as you mentioned, some crazy times. People lined up 20, 30, 40 deep to make offers. Yeah. Offers going 150, 300, 400 over asking price depending on the area. And this was even before the rates start coming up, and we'll talk about that later, Mike. But what was it? Just this steady movement north of this pattern going up? It concerned people, you think, or just getting worn out or thinking, you know what, this is crazy. I better back off a little bit. What are some of the contributing factors that's backing off and slowing down?
I think you hit it right on the head with, the people just kind of getting sick of what was going on a little bit. And there's a lot of different reasons why. One of the other reasons is that a lot of people in Silicon Valley have their wealth tied to the stock market.
Good point.
And when the stock market goes up and down, there's actually a really great chart that Antero has. It follows the S&P 500
mm-hmm.
in Silicon Valley home prices. And it's pretty amazing how much it mirrors the actual each other. It's really kind of interesting. The other factor is, is inventory went up this year. So when you have more to choose from, you're going to have less less of a bidding war. And then I think one of the other reasons, and I'm probably forgetting one here, but one of the other reasons is that we also had sellers that became a little bit more greedy than in years past. They had seen what had been going on, and I'm just telling it like it is.
Yeah.
They had seen what had been going on the last 3 or 4 years, and they're like, hey, I want to jump on this train.
Right.
They're overpricing their houses, not prepping them, and then houses are sitting on the market longer than they had in years past, and then all of a sudden the newspapers get a hold of that, and then they blow it out of proportion into something it really isn't, saying that, oh, houses are sitting on the market longer, blah, blah, blah. Well, in my opinion, that was really just the fact that sellers and a lot of people in real estate were probably getting a little bit greedy, and it just took a little bit longer to sell, and they missed the boat, basically.
Yeah.
So,
one of the nice things you said it earlier about being normalized, is that I'm seeing, and I'm sure you are too, which is kind of refreshing for home buyers, is that people are actually thinking, wow, maybe I could go look for a house, possibly, find a house, decide that I might like this house, and then actually think about putting my house on the market. So now contingent offers aren't so scarce anymore. Are you seeing more of those?
Yeah, definitely seeing more of the contingent offers. There's more of an opportunity for those people, to both sell their house and move up in another house and not have as much competition. So, yeah, we definitely are seeing that for sure.
On price points, Mike, is it still strong in terms of if you're a seller, if you price the home right? I'll preface that because I know some people, like you said, were taking advantage of, let's just throw some crazy number out here.
Yeah.
But if you have it priced right in the right area, is it still, is the price point still staying pretty strong?
It is. If it's priced right is the key to that. What's interesting, I'm looking at, I pulled up a couple charts, but if you look at all of Santa Clara County, which is a lot of what you and I talk about on the show, people that listen to the podcast, know we're based out of Silicon Valley, which Santa Clara County is the main county in Silicon Valley, so we look at those numbers quite often. If you look at, I have a line graph of the sale price to list price ratio. So even at the end of the year, it's still over 100%. So what that means is it's about 101.5%. So what that means is if someone's listing their house at $1 million, it's most likely selling for slightly above the list price. Where that went throughout the year, it started at about 102%. And shot up to about almost 106% in March, April, May, and then steadily declined throughout the year. But we're still above 100% sale to list price ratio. So what that means is what they listed at and what it sells at is typically at or above list price. So I think that answers your question in the sense that, values are looking pretty strong. And the other thing to look at too is days on market, how long it takes a property to sell, which in Silicon Valley is averaging a little bit around a month, probably give or take a couple of days. That varies throughout the year. Earlier on in the year, it was over a month, about 37 days. It got all the way down to 20 days in May, which is typically the height of selling season, and now we're back up to about 33 days. And then that's going to get a little bit longer as December goes on, but it's still a very short amount of time to sell a property.
Got it.
So
what? One of the things that I love about doing this show, and we do a lot of research. I know you do, I do, and we come prepared. Obviously, we try to. There's there's not a science involved, but if you come prepared, and the reason I want to bring this up before we finish up our first segment here and take a quick break is that we've been talking about. I know we have done some joint shows. I know I certainly have individually about the last 6 or 7 months. Why it's such a great time to get out there and buy. Yeah. And later on, we'll talk a little bit about the rates and, even more reason why we've been telling people, as we are seeing this market change and really come out of this strong seller's market and maybe a normal market, as you'd mentioned, that now it provides opportunities for buyers to really have less competition and the stress of not having these. It was crazy before. I did feel bad. I know you, working with some individual clients, were like we did together, wanted something so bad, but at the same time, what if I got to sell my house, and what if it doesn't work? And we forget because we're in this business and we do it every day, but it is a gut check every once in a while to realize these are real people with real families, real concerns, it's real money, and when they make these decisions, you don't want to feel like you're forcing them into something.
Never. I mean, I never want to do that, and I know you work the same way, and yeah, it was a gut check a lot, and now it depending on, and I want to preface that with depending on the price range they're in and the area they're looking at, because there are some areas that are still extremely competitive, but for the most part, it's gotten a lot better. People have more to choose from, and it's not as hectic as it had been in the past. So that's a good thing, and I think that's going to continue into 2017. God, it's weird to say 2017 already, but it's going to continue into that. And again, we live in the Silicon Valley, in this world, our own little world here, where things are, in my opinion, going to continue to stay good for quite some time. So it'll be interesting to see.
Before we take our quick first break here, so what would your message be then? We'll talk more on the other side, too. What would your message be to the person that's asking you, or you picked up the phone calls, you were meeting with them today, Mike, and says, what do you think? Should I buy now? Should I get out? I'm ready, but is it a good time?
I think we don't know. Well, we're going to talk about it on the other side. Rates are most likely going to go up. So, I mean, we've been saying buy now for the last few years, but really, I think this is really the time, because we know rates are going to go up. It's pretty inevitable, and they're still going to be good. I mean, it's not like it's going to be.
Exactly.
So, from a buying perspective, I think it's a good time, and especially even if you're listening right now, throughout the holidays is not a bad time to buy. If you're willing to make a move, now is the time, because there's still a good amount of inventory out there. It's going to start decreasing as the year goes on and into January, but there's less competition. People go in hibernation during the holidays, and so there's less competition as other buyers. There's not as much to choose from, but there's still going to be less competition, which is always a good thing. And so I would say, from a seller's perspective, again, I think it's going to be a good time to sell again in Silicon Valley for a while. So I think, either way, it's good.
Very good. All right, we're going to take a quick break. We're going to come back and continue the conversation. It's Mike 𝗔𝗕𝗪𝗏 and I, and we're doing an end-year review of the mortgage, what's going on in the mortgage. We're going to do next segment. We just wrapped up a little bit about real estate. We'll continue to do that. If you want more information, go to 𝗓𝗡radiolive.com. We'll be back with you in just a minute.
For more information on today's program, visit 𝗓𝗡radiolive.com. That's 𝗓𝗡radiolive.com. Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit 𝗓𝗡radiolive.com. That's 𝗓𝗡radiolive.com. Again, your host for today's edition of Real Estate Radio Live, 𝗘𝗀𝗁𝗍𝗂.
Welcome back in, 𝗘𝗀𝗁𝗍𝗂 with Real Estate Radio Live, the podcast series. I'm sitting here with Mike 𝗔𝗕𝗪𝗏. Again, just a reminder, we'll be doing the podcast 5 days a week. Mike and I will be doing Tuesday together, so be sure to tune in. For more information, you go to 𝗓𝗡radiolive.com. And also, the topic today, that we're doing a year-end review, Mike and I, and we'll continue to do that. We're going to talk a little bit about mortgages. Before we do that, just a reminder, if you're listening to the podcast and you have any needs for real estate, buying, selling, any advice at all, Mike is the person to contact at 408-630-0101, or go to his website at MikeDSells.com. Need any mortgage advice, financing information, I'm here to help you at 408-838-9060, or you could go to 𝗓𝗡radiolive.com. All right, Mike, let's talk a little bit about mortgages.
Yeah, so what are you thinking? I mean, where are you seeing obviously we're going to have a new president, and not to make this a political show.
Let's do it.
But what are your thoughts? I mean, where do you see rates going? We've been talking about them bumping up for a while now, so is that going to happen?
We could push the envelope now. We're on podcast. We're on live radio. We don't have the FTC to deal with, or all those characters. So, it's kind of interesting. Before the election, or right when leading up to it, a lot of the market was saying, or hearing, was that, if Clinton was going to take office, that there would be kind of normal, nothing would really happen, no market adjustments.
Yeah.
And then they said if Trump took office, or the likelihood of that, if he was elected, that we may see a big downturn in the stock market.
Yeah.
So it was interesting the night before. I don't know if you saw. I mean, I was really engaged in watching that election. It was unbelievable how it really unfolded. But the markets afterwards were actually the pre-markets before they opened. You see, at one point it was down like 800 points.
Oh, what?
Yeah.
So I was in Ireland when the election was going on. So I was waking up at like 3-4 in the morning.
We had a serious
check.
election going on. He's in Ireland.
I was so like interested in the election. I forgot to wish my wife a happy birthday the morning of the election because I was.
You got a future ahead of you.
Yeah, I know.
It
was interesting morning after I finally remembered. But so I didn't really follow the stock market. So that's what happened?
So it was down. It was down. In the pre-market for. Kind of 800 points or something, which is interesting. So then everybody was like, brace yourself, buckle up the next morning. And then by the time the next morning rolled along, really a couple hours after the market opened, it was up.
Yeah.
And now, as you know, most of us know, it's been up ever since.
Yeah, it has.
So this is just another example, and I don't want to get on my soapbox. I did a little bit before, right after the election. This is an example of taking responsibility for yourself, doing what you can for yourself, your family, your own investments, absolutely. Right? Yep. Instead of sitting around and worrying, what's going to happen if so-and-so gets elected. I don't believe in that. I mean, you have to go out and vote. That's our right, our responsibility. We should go out and vote and be involved and educate ourselves. But no one's going to take care of yourself or your family other than you. No, I couldn't have said it any better. I totally agree. So, what are your thoughts on one of the things I've been reading with Trump coming into office, and tell me what you think about this, is because he's all about, maybe providing regulatory relief and not making things so difficult or controlled by government. And what industry more so than mortgage, and you do this, is controlled by that, some of these ridiculous things that you have to do. Now, I'm not saying he's going to completely strip it all of regulation, but do you think that that's going to be helpful and maybe ease some of the credit for potential borrowers, or what? I think there will. I think there'll be. No, that's a good point. And if you follow the trends, and if you think, we'll see what happens the next couple of years, Mike. But I really do think some of the financing, some of the constraints will be eased a little bit in underwriting and jumbo, especially. Honestly, in my opinion. And I live and breathe this business. If it's Fannie Freddie stuff and it's conforming, if it's loan amounts under 625, honestly, it's pretty simple. Yeah, it really is. Just because pretty cut and dry. It's underwritten. It's this. You get DU approvals. They buy and sell it all the time, so it's easy. But when you get into jumbo, unfortunately, it's still very, very stiff and tough. And so I do think some of those will be relaxed. Yeah. I think the bigger part of that too will be. You asked about compliance. We are the most heavily regulated industry, maybe other than financial planning, financial services. Yeah, it's pretty heavily regulated. Absolutely. So I believe that also Dodd-Frank, which came into play, which created the CFPP and a lot of other things that really have made our life miserable, and quite frankly, consumers too. Yeah. They come up with documents and policies that they say this is going to be easier, and they still scratch their head and say this is more confusing. Absolutely. So I do think some of that, we'll get some relief from that. I'm hoping that the results will be that some of the underwriting will be relaxed, some of the, the way the policies around that. So that's my hope. It's going to take some time. But what we did see, and I've talked about this for the last couple of years, and this is, again, what I love about this show. I've been telling people for 2 years now, take advantage of the interest rates. Do it and do it. Don't look back, because there will be a day when they'll jump up. And when they go up fast. Yeah, they do. There's none of this little trickle. No, it's within months. I think they've been up a half or 5/8 since the election. Yeah. And they haven't settled back down at all, and I think they're here to stay. So are they going to go a little bit higher? I do think there's a chance that they'll go a little bit higher. I think we'll see what happens in the first quarter, second quarter next year. Right now, Mike, 30-year money, if we're talking about conforming money, is around 4 to 4 1/8. 6 or 7 weeks ago was 3.5, 3 5/8. Yeah, it goes up quick. I don't know if a lot of people know this that are avid listeners of the show, but I actually started in the mortgage business. That's right. Back in 2008, doing secondary marketing. You took a beating early. I did. I know. I learned. I got out of it. No, I'm just kidding. But no, I started and I was doing
I was doing rate. I was actually making the rate sheets for a mortgage company. I was called what's called a secondary marketing specialist. So you're essentially like a stockbroker for a mortgage company. And I was doing the rates every day, and typically they go up much faster than they go down.
Yes.
And they change daily and even multiple times a day. You know, you probably get price sheet changes on multiple times a day. So just keep that in mind. And just like you mentioned, in the last 6 weeks, it's gone up over a half point. So that's interesting.
Yeah, I would just say that, you know, the point is it's still, historically speaking, when we're talking about interest rates in the low fours even, really, really good. If you were fortunate enough, like a lot of us, to have interest rates in the 3 range somewhere along the line, and then 15-year was even in the 2%, high 2% for a while. Take advantage of it. That's great. Move along, but at the same time, I think this has also caused people a little bit of pause, maybe a little bit of shock. Oh my God, rates are up. Now what? But it's still a really, really good time to buy.
Yeah,
it really is. And so,
what are your thoughts on programs? What do you think? Or you think there's going to be any different new programs coming out? Any easing of different programs for loans, or any? I don't know.
I don't think. I was a little surprised. I said at the beginning of 2016, I thought we would see some more stated income programs, and we didn't. We did see some programs that were kind of like stated, the bank statements, and they asset driven and different things like that. And there's some programs that surface, Mike, that are a little bit better than hard money, but not, for instance, we have some investors that take a little more risk. The DTI could go a little higher, foreign, some different citizenships and stuff, but you pay the price and rate. So you're about 1% higher in interest rate, So there's some of that. But again, with Trump getting into office, this could ease some regulations. It could. What we really need is the market to have a bigger appetite for mortgage.
Yeah.
For jumbo mortgages. Yeah. That's what we really need.
Well, especially in this area, though, too, because that's, the housing prices are so expensive. I mean, we see a lot more jumbo here than elsewhere, right?
Yeah. No, we do. So just as a review, I'll just finish up on the mortgage side. We have just a couple of minutes left in the show, but rates are up a little bit, as we just mentioned. I think they'll go up a little bit more the first part of next year. I wouldn't be a bit surprised if by this time next year, for instance, we're close to 4.5% on 30-year money.
Yeah, good. And I would say on the real estate side, we had been seeing double-digit appreciation 2012, 13, 14, 15 even. I don't know where this year is going to come in just yet. I would guess it's not double-digit. And I'm talking Silicon Valley, or it might be close to that. But I would say probably next year going to be more in the 5 to 6%,
okay.
Is my guess. So we'll see what happens.
And do you think also we're probably going to stay in that normalized market as far as you could see?
I think so.
In terms of the big ebbs and flows.
Yeah, basically with the inventory and where that's going, and I think it's going to be pretty normal going into 2017.
All right, so you are you heard it here. You heard it from Mike and I remember. I just want to do a summary.
Don't hold us to it, though.
Yeah. You know where to get us.
Yeah.
I just want to summarize again and let the audience know, the people listening to the podcast. First of all, thank you for tuning in. We appreciate it very much. We're going to continue the podcast series. Mike will be doing the Monday show, very similar to the radio schedule. Really, Mike and I will be doing Tuesdays together, which is be fun.
Be a good time.
Wednesdays and Thursdays, I'll be doing it myself, and then we're back with Bobby and Buddy on Friday. So what I'd like to ask you to do as we tune out today, as we always do, please go to 𝗟𝗡𝗙Radiolive.com for more information. And we'd love to have you do 2 things. First, share the podcast with your friends, coworkers, family members, and also do us a big favor for Mike and I. Give us some reviews. Go on to iTunes or go on to our website, 𝗟𝗡𝗙Radiolive.com, and give us a good review. And tell us what you think. It helps our business quite a bit. So, Mike's great.
It was great. And reach out to us too if you. I like when we were doing the live show, people reach out, have questions. We've created whole shows around topics that listeners are reaching out to us about. So
very good.
Feel free to reach out. Call, email, whatever.
Where could they email you?
Mike@𝗥𝗲𝗋𝗋𝗔𝗕𝗢𝗪.com.
Okay. Joe@𝗟𝗡𝗙Radiolive.com. Thanks again for tuning in today. Until next time, take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.